So we're going to be talking about REITs today, okay? We're going to be talking about what is a REIT. Is it better than investing in actual real estate? Is it a perfect investment? Or is it too good to be true? We're going to be talking about that today, okay? So let's start from the beginning. Who am I and why am I even qualified to talk about this? So my name is Jason Malbute. I'm a CPA. I've been a CPA since 2015. I've been doing taxes and accounting since 2013, and I've been a real estate investor since 2018. I've been investing in single family, been investing in multifamily. I'm a general partner on two multifamily deals in Atlanta, Georgia, but I started my investing journey in Indianapolis, Indiana. So that's a little bit about myself. Okay, so pay attention. There's going to be a quiz at the end of this presentation. Whoever gets the answer correct is going to win a special prize. So make sure that you are paying attention because you will definitely want to get this special prize. Okay? Alright, so what is REIT? So a REIT is it's kind of like buying a stock in a company, but instead of buying a stock in a company, you buy a stock in a building. Okay? So this is perfect for people who want to be passive investors. So you get the real estate exposure without being hands-on in regard to landlording. Speaking of landlording, there is no landlording. So that means no more late calls at night from your property manager saying that your unit is flooded. No more notifications saying that your tenant is not paying the rent. And no more fixing toilets at 4 o'clock in the morning. Okay? Another unique thing about REITs is that you get paid a dividend income, and also it's very liquid. So you could trade it like stocks. Unlike the regular real estate, it's very illiquid. So you know that when you invest in real estate in a traditional sense, you cannot just take your money out whenever you want. For you to get your money back, you would either have to sell the property or refinance, which could take months, if not years. But when it comes to REITs, you can sell your shares anytime that you want, and you can get your cash back pretty quickly. Okay, so we kind of talked about this, like what are REITs in reality. So I think my team made a great representation here on the right. So as you can see, you buy shares in a property. The property generates rental income and also appreciates. And then the REIT is required to distribute 90% of the dividends. And then you, as a shareholder, you're going to get taxed on that dividends. Okay? And then when you get that dividends, you report it on your taxes. Alright? Then as you can see here on the left, it talks about what is that definition of a REIT. A REIT stands for Real Estate Investment Trust. It's a company that owns, operates, and finances income producing real estate. And then you as an investor, you buy shares in the real estate and then you get paid dividends and then you own stocks, let's say, or shares in that real estate. Alright? So what's the difference between REITs versus directly owning real estate? So as you can see on this chart right here, here's the difference between owning REITs and owning real estate directly. So again, REITs is like buying shares, right? It's liquid. It's like stocks. You make money on the appreciation of the stocks, and also you get dividends as well. But the bad thing about REITs is that you have no control over the property. And I shouldn't say it's a bad thing because some people don't want control over a property because they don't want the stress that comes with that. But that's just one of the things to consider when you own a REIT. So you don't have any decision making power when you own REITs. Versus when you own real estate directly, you own the actual real estate. However, as mentioned before, the investment is illiquid, right? It takes time to sell, it takes time to refinance. Okay? It requires active management. Even if you have a property manager, even if you have partners, somebody has to manage a property. And if you have a property manager, somebody has to manage the property manager to make sure that they are doing the job. And then also there's so much more benefits to owning real estate directly. You get appreciation, right? You get leverage from the debt. You get depreciation, which is tax benefits, right? So those are all the positives of owning real estate straight up. And also you have control over the asset when you own real estate directly. So you get more decision making control. Okay, and then as mentioned before, REITs must. Okay, it's not a option; it's a must. They must distribute 90% of the dividends to investors. Okay, so where do REITs returns come from? Remember, I told you it comes through appreciation of the stocks and also rental income. And then you get the benefit from that as an investor when you get dividends and also when you get share price appreciation, right? Because when you own shares of a building, when the value of the building increases, so does your share value also. So this is something that we already talked about before. REITs behave like stocks. It's very similar to how stocks are traded. It's very volatile, right? So remember, traditional real estate, it could take months or years for the value to go down or up, appreciation. But stocks and REITs, they can decrease or increase in value much more quickly. And also, another thing to be mindful about is that when it comes to REITs, since it's similar to stocks, it's going to be more driven by market, okay? Market sentiments, to be more exact. So that means that economic news, investor emotions, investor risk appetite during that kind of time that can really drive up or drive down the prices of the REITs much more quickly compared to regular values of real estate if you own them directly. Here are some of the cons of owning REITs. So you unfortunately don't get depreciation, which is one of the biggest advantages of being a real estate investor. So why is depreciation a benefit to you? So when you own real estate directly, even if you are cash flowing, the depreciation can make it look like you have a paper loss. And then in some instances, you can have the passive losses offset your active income, whether that's your W-2 job or your active business. But in REITs, you will not be able to get depreciation and the tax benefits from it. Okay. Another thing is that REIT dividends is taxed as ordinary income, right? Which could be higher than long-term capital gains tax rates depending on your tax bracket. So that's something to be mindful about as well. Okay, so it's important to have your expectations and reality reconciled if you are considering investing in REITs. So people invest in REITs, especially people who are just starting to get into real estate, and they incorrectly think that investing in REITs is just like investing in traditional real estate, and that's not true, as we have discussed before, right? It's more like investing in stocks and not really real estate. Because not only do you not get the tax advantages of investing in real estate when you invest in REITs, but on a personal level, you also don't get that hands-on experience of being a real estate investor. And then obviously when you invest in REITs, it has very limited tax planning and flexibility. For example, if let's say the REIT sells the property that you invested in, you cannot claim a 1031 exchange on that. Versus if you owned a property directly, then you could definitely implement more tax strategies. Whether it's doing a 1031 exchange, doing bonus depreciation, qualifying as a real estate professional, or benefiting from the short-term rental loophole. There's just so many tax advantages when you own real estate directly versus when you own a REIT that's not really that much or any tax advantages to it. Okay. So who are REITs best suited for? REITs are best suited for people who want to be passive real estate investors. And when I say passive, I mean really passive. Like you don't have to do anything in regards to managing the property. You don't have to coordinate with a property manager. People like that who just want to be very passive, REITs are the best option for them. Also, if you want portfolio diversification, REITs are a great choice because you can buy REITs across several properties so that you can spread your risk. Versus when you invest in traditional real estate, most than likely you're investing a big chunk of your capital into one rental property, which is obviously more risky. Okay, and also REITs are more income focused because you are getting dividend payment. Okay. Versus traditional real estate, this is a better option for people who want to control the assets, right? People who want to do forced appreciation. What is forced appreciation? That is when you buy a property that is, let's say, neglected, that needs some love, you fix it up. Then once you fix it up, you can charge more rent. Once you charge more rent, you increase NOI. Once you increase the NOI, that's how you increase the value of a property from a commercial side. From a residential side, same concept. You buy a property that needs improvement, you fix it up, then you get the ARB to a higher amount, right? What's an ARB? After repair value, meaning that before you fix it up, it's only worth $60,000, and after you fix it up, you put 10,000 into it. Now it's worth $100,000. Okay, that's ARB. And then, as mentioned before, owning real estate directly, you get more tax strategy options. Okay. Alright, so we talked about this. There's a key takeaways, right? So again, you get no control over the property when you invest in REITs. You get no depreciation. It's kind of like buying stocks. And again, when it comes to taxes, the dividends is often taxed like ordinary income. Okay. Alright. So here's the fun part. I know that some of you guys came in late. So as I was saying in the beginning of the presentation, we are going to be doing a pop quiz to see if you guys were paying attention. If you get this answer correctly, you're going to get a special prize, okay? You're going to get a free tax assessment. A tax assessment is when we get on the phone for 15 to 20 minutes, I analyze your previous year's tax return, and I give you 1 to 2 free tax tips of what you can do right now to lower your tax bill, okay? So let's see if you're paying attention. Okay, so here's a question. What is the biggest disadvantage of investing in REITs? Okay, let's see if you guys were paying attention. I'll give you guys a few seconds to submit your answer. Okay, that's it. I'm going to pick somebody who's in the chat. Okay, let's go with John. Let's see what John says. John said that the biggest disadvantage of investing in REITs is that you get no control over the property, and also there's not that much tax planning opportunities like bonus depreciation. Let's see if John got it right. Ta-da, yep, John got it right. It's no depreciation, that's correct. You get no depreciation when you invest in REITs, okay? So John, please send us your contact information so that we could do a free tax assessment for you, okay? Alright, does anybody have any questions? I see that people jumped into the call. Some of you guys came in a little bit late, so if you have any questions, please feel free to ask your questions. MR, let me know if you have any questions. I'll give you guys a couple of seconds. Alright then, you guys, I guess there's no questions. So that means that everybody is an expert when it comes to REITs. Alright, so thank you very much. And if you guys ever want to, chat about your taxes and your bookkeeping, feel free to reach out. Thank you very much.